we'll win deals based on our service. And that's kind of the philosophy here. We offer a premium service, and I don't need to get into a rate battle with Bank of America, right? They can take me off the board anytime they choose.
Right.
I'd rather be consistent and service the heck out of my customers and have them come back.
Welcome back to ACS Portfolio Perspective. I'm your host, Andrew Pace, Chief Client Experience Officer at ACS. And today I'm joined by John Goujon, President of Unifi Equipment Finance. John brings extensive leadership experience in the equipment finance industry, including senior roles at Heller Financial, GE Capital, and Bank of America Global Leasing before joining Unifi Equipment Finance about 1.5 years ago. Under John's leadership, Unifi has achieved remarkable growth, reaching $145 million run rate in volume and growing their portfolio to $320 million last year, with ambitious plans for another $165 million in volume and $350 million portfolio this year. Unifi was recently recognized as one of the Monitor's top 100 leasing companies this year. Perhaps most impressively, Unifi maintains exceptional credit performance with delinquency at just 0.28% and annualized charge-offs at 0.12%, significantly outperforming industry averages. Based in Ann Arbor, Michigan, and owned by the Bank of Ann Arbor, Unifi has built a reputation for exceptional service that drives strong referral business and sustainable growth. John, welcome to the show. Great to have you here.
Thanks, Andrew. It's great to be with you. Always great to see you. It feels like a conference, right?
Right. It seems like we just saw each other. Seems like yesterday, but we last saw each other in Vegas back in February. How time flies. I mean, can you believe it? It's already middle of September. NFL, college football, NFL season is already
as you can see, I'm wearing a vest. So
yeah, and the weather too. Like hoodies are back, right?
Actually, today's my least favorite day of the year. We had to close our pool today, and it's always sad seeing the backyard with the pool closed.
Yeah, I have a few more weeks before I do that, but I'm not looking forward to cleaning up the millions and millions of leaves that are going to be falling at my house in the next couple of weeks.
Right.
So before we dive into numbers, let's start with the foundation. Culture and leadership choices often make or break a growth story. So let's begin with how you set the tone at Unifi. What were the first 2-3 moves you made that unlocked Unifi's recent growth and performance gains?
Yeah, that's a great question, Andrew. I would tell you that when I came on board here, I was blessed to find a very, very talented team of professionals, ready to roll. In fact, I had worked with Danielle Patty back at U.S. Express Leasing years ago when we started that platform in Parsippany, New Jersey. I had made a commitment to the bank and to the chairman of the bank that I wouldn't really make any changes or tweak anything until I took a good hard look at the process and understood what Unifi did and what our go-to-business model was at that time. After spending 60, 90 days kind of observing and talking to people, it was pretty apparent to me that this place was a machine, particularly in the operations side. I would tell the team, I'm going to break the machine. My goal is to break the machine. I knew that they had throughput capacity, and I was really curious as to how much it could withstand. The go-to-market strategy. The prior go-to-market strategy was to build a portfolio through tranche acquisition, more of an indirect model. I'd hoped to move into a more direct model and own the deals that we're putting on the books. Hence the idea of breaking the machine. The response was great. I think there was a little bit of culture shock when I first came on board. One of my core tenets, one of my core beliefs particularly from a leadership perspective, is the belief in resident expertise, right? So, for instance, my director of credit and portfolio, Tony McHugh, one of the best credit guys I've ever worked with. I don't need to have the highest credit initial when I've got that kind of talent on the team.
Mm-hmm.
They were accustomed to a more centralized decision-making process and funneling decisions into a centralized process. My expectation was, you've got the role, you're the right person, you make the decision, right? So my challenge was empowerment and helping them get to the point of taking the next logical step. And I think that came as a bit of a surprise. So once we got through that, and they understood that a lot of this is based on trust, right? I put my trust in my team, and I trust that they're the right people to execute. And I asked them to put their trust in me from a vision perspective. After that, we were a rocket ship ready to go.
And you mentioned, build through, you unify it, build through tranche. Can you talk how, the shift from the reliance on that wholesale paper to building, more of a direct portfolio, the rationale? How did you sequence that transition?
Yeah. So when you look at the income lines, the revenue lines, a good percentage of our income line is derived from non-interest income. In the commercial paper market or the tranche market, you prohibit yourself from executing or taking advantage of documentation fees or interim rents, et cetera. When somebody else originates the transaction, they keep the fee. Well, I wanted to grow that non-interest income line. We had some excellent partnerships in place in the broker market that were still doing transactions on our paper, so we had the opportunity for fee income. But on the tranche side, you don't see those opportunities. We were really fortunate that some of the relationships that had left the company over the prior years decided to come back and give us another shot. And really, the growth last year was largely organic from those relationships and the relationships that were in place growing, as well as relationships coming back. So little by little, we peeled back. I think tranche business represented roughly a third of the originations. We've got that down, around 10% now. My goal is to continue pushing in that direction and, building out our direct model and controlling the fee income that we can generate from that.
And I love this word that you've used in the past, thoroughbred, thoroughbred organization philosophy. Yeah. How did it change the organizational design, accountability, and your decision speed?
Yeah. So as I mentioned earlier, blessed to have a great team. Yep. I've got people on the team that have been here 30 plus years that are holdovers from the old urban leasing days. So they know the market, they know the business, they know commercial equipment finance. The Bank of Ann Arbor bought Urban in 2013, and I don't think they really knew what they had in a commercial equipment finance business. So during those first 90 days of observation, I got this idea that the platform itself was strong. The platform itself was a machine. And I was talking to my boss one day, and he wanted to know what the magic elixir was that allowed us to go from a budget of $104 million to $143 million in originations. And I said, I have no magic. It's nothing that I've done. I said, the team was like a thoroughbred back in the pen. All I did was open the gate and let them run. And it was obvious that they wanted to run and they could run. And it's kind of that concept that led to the idea of breaking the machine. Let's see how fast this horse really is. Let's see how much we can take on. And even going with that kind of exponential growth, it never broke. So we set our goal a little higher this year. We went from a budget of 104 million to 150 million, and we're hoping to close the year, north of 170. So yeah, and we haven't thrown bodies at it. We've just, executed against the plan, and in addition to the idea of resident expertise, there's another big element, and that's communication. So one of the things I do, Andrew, we have weekly meetings. I have a leadership team, which consists of Tony McHugh on the credit and portfolio side, Danielle Patty on the ops side, Tim Otto is our CFO, and we get together every week and talk about what the week looks like and where we are from a plan basis, what our objectives are, et cetera. And then they go out and talk to their teams, right? And then monthly, I get the whole team together and we have a monthly all hands meeting and we walk through the numbers, right? So who can tell me what SOFR means? Nobody knows what SOFR means, but we use that venue as a way to educate people and share the common goal. I get no more joy than hearing my vendor service reps talking about what they can do to help us get to our non-interest income goal for the month. Everybody has bought in. Everybody feels a sense of ownership. We're all one team. And I think that really, if you had to say what the magic is, it's making sure that everyone knows the plan and feels a part of it.
Seems like that's the magic, right?
Yeah.
Just everyone understands the vision. They understand, the direction, and everybody's pointing in that same direction.
Right.
So what would you say are some of the leading indicators that you watch weekly or monthly to know if your growth is healthy versus merely just growing fast?
Yeah. So a couple of things. We made a strategic decision to focus on certain asset segments, core businesses that we wish to pursue, and we base those decisions around our knowledge of the assets, our knowledge of that market, of that user base or obligor base, and we try to stay away from areas that we aren't comfortable or knowledgeable in. So by focusing on a smaller universe and casting a narrower net, it allows us to be more expert in the areas that we choose to endeavor, right? Me, my background is in asset management. Mm-hmm. There's really nothing that I haven't seen or done, but that doesn't mean that skill set applies to this platform. So instead of, again, painting with a broad brush, we try to fine line it. And by better understanding the markets that we play in, it gives us a chance to anticipate extrinsic factors that may impact that. One of the examples I would give you, we do really well in the CNC space, CNC woodworking space, and I know we'll talk about tariffs and regulations in the later in the conversation, but specific to that market, we saw the global trade war impact that market directly. Why? Because most of those machine tools are coming out of Europe, out of Germany, out of Italy. Mm-hmm. The raw product, forestry products, are coming out of Canada, right? So you layer on tariffs, and now a piece of equipment that someone anticipated spending $400,000 on is going to cost $450,000 or $475,000. And by the way, are they going to make that CapEx investment this year during this uncertainty, or try to get by with what they have through the remainder of the year? But again, it's kind of fine lining and looking specifically in that market segment, as opposed to a generalist view and taking on anything that crosses the desk.
Gotcha. So let's talk about credit excellence and risk management. Leadership lens sets the direction, but durable growth also depends on guardrails. Let's shift from the culture you built to the discipline that sustains it. You're running roughly 0.28% delinquency, 0.12% annualized charge-offs.
Yes.
What would you say are the non-negotiables in your credit box that make that possible?
Yeah, so great question. Again, getting back to the Unify story and how it relates to Bank of Ann Arbor. So Bank of Ann Arbor is roughly a $5 billion community bank with not a great ton of experience in commercial equipment finance space. So the credit policies that were originally drawn and that we adhere to are more closely hewn to a community bank credit policy, which is fine, as long as it allows you to play in the markets that you're in. So, we're an AB lender, and we utilize all of the tools that most of our competitors do. Whether it's DMB or PayNet or Clear for background checks. We have a scoring model that James Jankowski and Tony McHugh have fine-tuned over the years. While it doesn't decision deals for us, it becomes a data point in our credit decisioning process. And we try to stay in our lane and within our boundaries when it comes to our credit racks, et cetera. Does that mean that we won't look at other transactions or make a stretch on something? Absolutely not. We certainly will, because we try to be problem solvers as well.
Mm-hmm.
So what does that look like? Maybe instead of funding 100% of the OEC, we ask for 30% down, or we ask the obligor to pledge additional collateral. Or we use structure, right? Maintenance and return provisions to strengthen our position. But I've said this before, and I'll say it again: we will never sacrifice credit quality or volume. Right? Credit quality comes first. We're pretty scrupulous in our portfolio review. We rescore our portfolio on a fairly regular basis. So we see trends that are developing or softness developing because we're constantly looking back and looking at the portfolio to see if there's any degradation or deterioration. And again, it's just that adherence to credit policy that has kept us in good stead.
That's a perfect segue into the next question I had, because I think that those decisions, obviously, when you guys exited over the road transportation, you did it before the downturn, right?
Yeah.
Can you share some of those early warning signals that prompted that call, and what would you bring it back?
So first off, I can take no credit for that decision. That decision was made long before I joined the company. All credit goes to Tony McHugh. Again, it's just a matter of monitoring the segments that you're in. And I think Tony, I don't want to speak on his behalf, but I think Tony saw some softening in a couple of our large relationships, saw some difficulties developing, made the decision in 2018, 2019 to start to exit that market. And we employ that same strategy now as we look at the different markets that we're thinking about. There's the power of big numbers, right? So if you look at the portfolio and compare performance over a period of time, bring that performance forward, it can kind of give you an indication of what to anticipate or what to expect. But again, it's no credit of my own. That was entirely on Tony McHugh.
Sounds like I got to get Tony on one of these podcasts.
Absolutely, yeah.
So how do you pressure test the portfolio today? Like which stress scenarios or concentration limits are the most useful?
Great question. So again, community bank, right? You have concentration issues on an obligor basis, concentration issues on asset collateral types, and because we're selective in the markets that we play in, you can see growth bubbles. Right, we're not spreading risk across a wide spectrum. It's more of a narrow slice. It is. It's the testing of credit scoring. It's scoring the portfolio, going back and selecting groups within our portfolio to take a deep dive on, which we do on a monthly basis. The team here goes above and beyond looking at the portfolio for indicative measures.
And with that being said, where would you see the greatest risk of adverse selection in the current market, and how are you guarding against that?
Great question. Obviously, over the road trucking has taken a beating, and I think it's starting to matriculate beyond that to last mile, which is an area that we have invested in the past. So then you start to look at, instead of the last mile delivery as a whole, are there geographic centers that stand out? One in particular is the greater Chicago area, right? It's all the railheads, all the marine stops. So a lot of destination to destination deliveries, going from a rail depot to a trucking depot. It's starting to slow down. Well, does that mean that is going to have the same impact, in the Port of Long Beach? That's something that we'll have to look at. And again, I think it all stems from how well you know your market, how well you know your customers.
Great, thank you. So with the risk framework in place, the next question is how you compete and how you can still grow. Let's move from the guardrails to go-to-market playbook, referrals, service, pricing. Unify has grown through referrals and service. What specifically drives referrals for you, and how do you measure and encourage those?
Sure. So I would tell you an anecdote. I was talking to one of our sales guys the other day, and he was talking to a CNC machine tool guy, and this person told him, yeah, you're in a tough space. Everybody has cheap money. Everybody over services. Everybody has app only. And our app only is up to $750, so it's a little different than the norm. But basically, he's telling us. He told the guy. He said that you guys are a dime a dozen. Yeah, but we're not. Work with us. See what it's like, right? We can credit decision in a couple of hours. We can same day fund. Again, we have app only up to $750. But I think the biggest differential is if you have an issue or a question, you can pick up the phone and talk to our head of credit. You can pick up the phone and talk to our credit manager. You can pick up the phone and call me. There are not a lot of big banks or too big to fail banks that you would expect to be able to hop on the phone with the head of credit, the head of chief of risk. We're very involved with our customers. We're very reachable, accessible. And our service, I would put us up against anyone from a service standpoint.
You mentioned service, so exceptional service. So what does that mean operationally? Your response times, SLAs, and the post funding support.
Yeah. So a couple of things. First, I would tell you that we're not remaining stagnant. We're investing in a new front end system to help expedite the process. Our general turnaround time is 2 hours or less on a credit. Does that mean that we turn deals in 2 hours? No, we can turn deals in 15, 20 minutes if all the necessary data is there. We can same day fund if we can get docs out and use e-docs to close the deal. From a service standpoint, I would take it a step further. For us, the relationship doesn't end at the account executive level, right? We've got the machine, my VSRs, the vendor service reps, who develop relationships with our vendors. And the feedback I get from the vendors and from the support we provide, whether it's calling to get a doc through the system, getting a wire out, or at the end of the month, their activity statement, which shows their entire pipeline, where deals are in that pipeline, what we expect to close in the next several weeks, et cetera. All that goes out at the end of the month. And, I get the nice emails back thanking us for the service. And, I think that's part of what separates us from a lot of our competitors.
Great. And, we touched on briefly earlier about tariffs and especially with the CNC and woodworking. How else are tariffs and trade tensions showing up in the demand in other industries that you guys are currently involved in?
Yeah. So I apologize. I have a little bit of a scratchy voice. So we're seeing it across the board, and whether it's, again, raw materials, price of steel, price of aluminum, the import tax on equipment coming from overseas. So our philosophy is it's a soft cost, right? We have a certain tolerance for soft costs up to a certain percentage, and if the tariff falls within that percentage, we're okay with funding it. If it exceeds that percentage, then the expectation is the obligor has to make up the difference, in the down payment, et cetera. I think the bigger impact, Andrew, is less the what we see, the immediate concern, and it's more the long-term concern, because no one knows what tomorrow looks like, or next week, or next month. I've compared this year to last year, and the uncertainty in the air last year. Last year, money was sitting on the sideline. People were hesitant or reticent to make that CapEx expenditure leading up to the election. Mm-hmm. In my opinion, it didn't matter who won the election. Money was bound to flow back into the system, right? You've got the pent-up demand. You've got the safety valve release of the election. Okay, it's time to get back to business. We don't have an election pending this year, right? This malaise that we have felt, I think, is going to have a knock-on effect and a carryover into 2026. The Fed's going to make an announcement next week. It's already priced in the market that it's a quarter point drop. With the tick up of inflation, it's highly unlikely it'll be anything more than a quarter point drop. Right. So what does that tell you? More malaise, right? So my concern is less for the immediate impact of tariffs and more concerned with when do we relieve this tension? When do we relieve this uncertainty and get back to business?
I even heard that in some instances that there were going to be 2 quarter point drops, and they've already baked in that second quarter point drop in. Which obviously we may not see for, several months, but, right. There people already maybe baking that into some of the new rates that they're offering. Competitors are pushing aggressive pricing. Where do you guys hold the line? And I apologize for my scratchy voice, because obviously, I'm still regaining it from that exciting Bills game from the other night.
There you go.
So where do you guys hold the line, and where are you willing to flex a little bit?
Sure. So first off, I'll say Ralph Wilson was a native Detroiter. So, the Bills have made a home here in Detroit when they can't play because of the snow, and they're welcome back anytime. The Bills Mafia are a great group of people.
Thank you. We love coming to Detroit. We love Detroit's like a second home for us Bills fans. So
exactly,
if we can't win, we want Lions fans to enjoy one too.
There you go. And back in the old days, we would have hitched our wagon to the Bills, but now we've got the Lions playing the way they should be. So we'll see what happens.
It's exciting. It's exciting.
It is.
So where's Unify willing to hold the line, and or where do you hold the line, and where are you willing to flex? Because we can always talk Bills Lions at any time.
Well, I'm really glad you asked this question. This is kind of a point of pride for me. We are hopefully a voice of stability in the market. We've not really changed our rates at all for 7 or 8 months. You see this every year as you go into the fourth quarter. Companies who have struggled from an origination standpoint pull out all the stops, right? Drop rates for volume's sake because they need to hit numbers. We've been consistent with our rate cards. In the best of times, we review the rate cards on a monthly basis just to make sure we're competitive. That doesn't mean we're going to change rates, and if we do, we are surgical in the way we change rates. It's by business segment, et cetera. But I'd rather be seen as the voice of stability and consistency as opposed to that variable that pops in and out of the market. Look, there's always someone out there that's willing to be the lesser fool, right? And drop rates. My partners know that I'll always be here, right? If you want to go and chase a low rate for a month or two, we'll still be here when you come back. So to that extent, we've been very stable. We are making, I think SOFR dropped 70 bips over the last 4 weeks. So we're making some modifications in our base rates for going into the fourth quarter, but it's certainly not some of our competitors that you see swings on a weekly basis or a monthly basis.
We talked, going into the fourth quarter, going into 2026, which niches or asset classes are you leaning into, and which may you de-emphasize, or which ones might you de-emphasize from?
So I think the stable of products that we have right now, I'm pretty happy with. I think there may be some aggregate concentration issues in the vocational truck space, so we may take a look at that. But really, I think the portfolio is in really good shape. It's performing very, very well, and there's nothing indicative, at least at this point, that would cause me to want to retreat from where we're at. So the other side of that coin is, where do I think we can invest going into next year? We've done a really solid job in the smaller construction space, in the aerial work platforms and residential equipment, backhoe loaders, wheel loaders. I think that there should be an opportunity next year on some of the larger construction gear. So we may try to do something there. But other than that, there's no sector that I would see us chasing at this point.
Okay. So we've covered the inside of the business and how you win in the market. To wrap the content, let's zoom out to the broader industry landscape and the economic signals you're watching. What's your base case view for the next 12 months on demand, defaults, funding costs?
Yeah, so every one of these questions is just so pertinent. I think the cost of funds with rate concessions, with the lowering rates, that will ease up a bit, but it's the spreads, it's the margin. Again, talking about the SOFR rate dropping 70 bips, the prime lending rate is still sitting at 7.5. So it hasn't matriculated out to the commercial market or the consumer market. There will always be that demand for spread. We borrow directly from our parent bank. So is it a competitive edge? I think in certain cases. In other cases, the captives have an advantage with blind discounting and 0% financing. I think the jobs market, the fact that it's tightening a bit, seeing what happens with the global the global trade war, if that eases up, I think there's plenty of demand pent up that could develop into a robust 2026. Am I optimistic about that? No. If we continue to see incremental increases or I should say incremental decreases in job creation, increases in unemployment, and inflation ticking up, that's a recipe for a pretty difficult 2026. So I think there's plenty of headwinds that we're moving into. From a unified perspective, it makes us all the more cautious when it comes to our credit decisioning, and at what point we're whole in transactions. It makes us less likely to be creative and more likely to stick to our knitting. And I think from an industry standpoint, you'll probably see some of that as well. I don't know what the big banks will do, but again, fourth quarter, everybody's jumping in. Will they be back again in the first quarter? That's the question.
Yeah. And, obviously we know transportation's been choppy. What's your read on timing and what signals will confirm stabilization?
I think the first thing we have to do is get past the tariffs and trade war, and just bring some stability back to the general market. You look at the PMI index. I think it was 48.7 last month, which was an uptick from July. So that's positive, but it's still below that 50 line, which is still negative territory, right? So we want to see that an improvement there. I think demand for goods sold has been fairly consistent, but I don't know what the demand for raw products has been. And, that's a driver for industry. And our market, it serves industry. So I think in answer to your question, I'd look to the PMI, I'd look for, the cost of raw goods as bellwethers or indices as to the state of the industry.
Great. No, thank you. Those are great. Great. That's great insight. And how do you weigh pricing discipline versus, share gains when the cycle's late and obviously uncertainty is high?
Yeah. Again, I think there's real value in being the stable guy, right? Stability itself has value, as long as you're competitive. Going back to some of my prior roles, at the GEs and Bank of Americas at the time, we didn't have to be the lowest player, right? As long as we were in that group of 3 or 4 or 5 and we're competitive, we'll win deals based on our service. And that's kind of the philosophy here. We offer a premium service, and I don't need to get into a rate battle with Bank of America, right? They can take me off the board anytime they choose.
Right.
I'd rather be consistent and service the heck out of my customers and have them come back.
What is one contrarian take you hold about the equipment finance cycle today, and what would change your mind?
Great question. I think the general thought that the legislative changes, tax changes, bonus depreciation was going to light a fire for true leases and fair market value structures. I just don't think that that's something that's going to come back, at least not to the level that I knew it, right? and I think that the overwhelming counter to that uncertainty. Bonus depreciation is great, but if you're not making a CapEx spend, you're not going to benefit from bonus depreciation.
Great. No, thank you. And for operators listening, what is one practice they should adopt this quarter to strengthen their portfolio resilience?
Yeah, review your portfolio. Look, try not to be biased, right? Data is data. Data points are data points. Use them to your benefit. Look for softness. Look for, and again, we talked earlier about the Chicago transportation market. Look for not only equipment concentration issues, but geographic pressure, right? That can turn a table pretty quickly. And the data's in your portfolio. Just look at your portfolio.
That's great advice, John. Lastly, who's the better quarterback, Josh Allen or Jared Goff?
Oh, come on, man. Jared Goff. No, I know. I love Josh Allen.
I had to throw that in.
Josh Allen is my favorite quarterback, so I'll give you that.
I do love your coach, by the way.
Oh yeah,
I do love your coach.
Fight the kneecaps.
That's right. Before we go, do you have any questions for me?
No. How's business? What are you seeing? I mean, you guys see all the dirt, right? You see the downside of the industry. So what are you seeing?
We've noticed a drop off in transportation assets, although we've seen quite a bit of fleets. We've handled a couple of large fleets simultaneously. Placements have year over year, placements have dropped, but we've seen obviously an increase in the number of assets due to those larger fleets being assigned out for repossession. And as you pointed out, some of the busiest areas for us in the transportation space still, remain are California, Illinois, Texas, and then we are also starting to see an uptick in some of the construction recovery assignments. And again, a lot of the areas that we see, most of those are the biggest percentage of some of our construction assignments are in Texas, Florida, Georgia, Tennessee, California. So transportation, and again, I think usually that it follows suit. Transportation is usually the first, industry to, get affected, and then some of the other industries follow suit. So that's kind of what we're seeing right now. And we're just, a lot of things that we're hearing, things people are hoping that things are going to start to improve in maybe early mid 2026. But no, we're growing, and we're looking for ways that we can be a better service strategic partner with our clients through trying to mitigate those trying to prevent more repos by getting involved further upstream through either soft call first party collections to pre-repossession collections and even door knocks. We're doing a lot of door knocks, delivering letters, and that's really we're preventing a lot of accounts from being flipped to repossession, and we're banks are really saving a lot of money and costs for repossession, transportation, make ready fees, remarketing fees, and things like that. Just by having somebody deliver a letter, knock on the door, and it's made a significant impact. So, but yeah, we're getting. It's usually the fall is September, October are historically they're busier months for us, and then things obviously slow down as we get closer to the holiday season. So.
What are you seeing on the remarketing side? Are inventories shrinking? I read an article today that construction inventories are down, and I imagine that the cost of used equipment has risen. Are you seeing the same thing? Because majority of our clients handle their liquidation of their assets, so we just take it and drop it off. But I've saw some of the same things that you have, where the equipment, I think, the same thing where used equipment is at a premium right now. So, which is going to drive up cost of new equipment versus used, or with the tariffs and everything. So,
there's a lot of people, buyers have decisions to make, obviously. So do they wait, for rates to drop, and do they stick with what they have for now and maybe just deal with any maintenance issues that they're running into versus, getting into that new piece of equipment? So yeah, I'm seeing some of the same things, but because we're not remarketing the assets for our clients, we're bringing them to the remarketers. So
but you talk to all the remarketers.
We do. Yeah. I mean, we talk and I'll just say space is still at a premium because, there's been a lot of repos over the last few years. But yeah, I mean, space is at a premium. Yards are filling up. But yeah, that's, one of the things that like you, we're, just constantly looking at, the daily blasts that come out with, with that information just so that we're kind of ahead of the curve.
Well, unfortunately, and you and I both saw this with the post-COVID market, that price increase as the tariff costs raise the cost of new equipment, demand for used equipment goes up, cost of new or used equipment goes up as well, and then it creates kind of a false plateau and it becomes normalized. And now that that Freightliner Cascadia 26 that was selling for $135,000 new is selling for $190,000 new. And it becomes the accepted price. And as a finance company, we have to bear that in mind, that there's this false inflation of value, and then layer on top of that the cost of the tariff. So you're always asking the question: am I making the right investment? Is this going to come back to haunt me? Unfortunately, the prices never go down, right?
No,
or at least not at the same rate that they went up.
No, never. Right.
Yeah.
That's never, that's a true statement for sure. Well, I will tell you, this has been a masterclass, John, in balancing ambition with discipline, build the culture, harden the credit box, compete through service, and keep perspective on the macro. Thank you so much for sharing such practical insight. And to our listeners, thank you for joining us on the ACS Portfolio Perspective. If today's conversation was helpful, please follow the show, share it with a colleague, and leave a quick review. We appreciate you being part of the conversation, and we'll see you next time. Until then, take care and go Bills.
Thanks, Andrew.
Thank you, John.